You check the news. European markets are stable. No crash warnings. The European Commission forecasts modest growth. The ECB is cautiously optimistic. Everything looks fine, except your paycheck buys less than it did 2 years ago. Your rent went up again. You're saving less. Your friends are talking about moving back in with their parents. Not because they lost their jobs, because the math just doesn't work anymore. Something is broken. But when you look for answers, all you find are reassuring statements about resilient labor markets and controlled inflation. Here's what they're not telling you. Europe is already in a recession. It's just happening in slow motion. No dramatic crash, no Lehman moment, just a gradual, silent erosion of economic stability that doesn't make headlines because it doesn't fit the narrative of what a recession is supposed to look like. My name is Leo, and I hold a degree in European economics and business. I've spent 9 years analyzing economic data and tracking market indicators across Europe. You'll notice I use animation in these videos instead of appearing on camera myself. Why? Because I find that cartoons and visual storytelling make complex economic topics far more accessible and, let's be honest, more watchable. Economics can be dry, but the insights don't have to be. My focus is on giving you data-driven perspectives on European markets, and today I want to show you something that mainstream analysis is systematically missing. If you're trying to make sense of Europe's economic trajectory and protect your financial position, please subscribe and leave a like if you find this content valuable. Here's the thesis. Europe is experiencing what I call a hidden recession. The official data says no contraction. But when you examine the combination of stagnant growth, sticky inflation, rising debt service costs, collapsing trade growth, and deteriorating real purchasing power, the picture is unmistakable. This isn't your textbook recession with 2 consecutive quarters of negative GDP. This is something more insidious. A slow-motion economic decline that official statistics aren't designed to capture. And the reason it's not being reported is simple. There's no single dramatic moment to point to. No bank collapse, no stock market crash. Just a steady, grinding deterioration in living standards that happens too slowly to trigger alarm bells. By the end of this analysis, you'll understand exactly why this matters for your financial decisions. Let's start with what the official forecasts actually say. The European Commission's Autumn 2025 forecast projects EU GDP growth of 1.4% in 2026. That sounds positive, right? Growth is growth. But here's what that number actually means. 1.4% is barely above stagnation. It's lower than population growth plus productivity improvements in a healthy economy. For the Eurozone specifically, the forecast is even weaker, between 0.9 and 1%. France, Germany and Italy, the 3 largest Eurozone economies, are projected to expand by less than 1% each. Germany, Europe's economic engine, is in its 2nd consecutive year of house price decline. Prices fell 1.6% in 2024. This isn't a correction, this is a structural problem. German residential construction is collapsing. Only 215,000 new apartments are expected in 2026, down from 235,000 in 2025. That's a 9% decline year over year in new housing supply in an economy that already has a housing shortage. When the largest economy in Europe can't sustain its construction sector, that's not a cyclical dip. That's a warning signal. Now pair that with the inflation picture. The Eurozone is experiencing what economists politely call sticky inflation, 3.2 to 3.6% depending on the month and the member state. That's well above the European Central Bank's 2% target, and it's proving resistant to policy intervention. The ECB has been easing, but inflation isn't responding the way the models predicted. What you get is stagflation light, growth stagnant at 1% or below, inflation elevated at 3% or above. Real wage growth, when you adjust for inflation, is essentially flat or negative in many member states. Your nominal salary might go up 2%, but if inflation is 3%, you're losing purchasing power every single year. That's not a recession in the technical sense, but it produces the same outcome: declining real incomes, reduced consumption capacity, economic stress that doesn't show up in the headline GDP number. And here's the critical part. This has been happening for 3 years now. This isn't a temporary shock. This is the new baseline. Let me show you what this looks like in practice. Belgium, one of the wealthier EU member states, is experiencing record levels of long-term sick leave. Not because of a pandemic, because economic and workplace stress has reached levels that are producing measurable health impacts. When economic pressure translates into public health crises, that's a sign of systemic strain. Or look at housing costs. According to Eurostat data from Q4 2025, the median age at which young adults leave their parents' home has risen to 26.2 years across the EU. In Croatia, it's 31.3 years. Not because of culture, because housing is unaffordable. Rent consumes 40 to 50% of entry-level salaries in major cities. Home ownership is out of reach for an entire generation. When the fundamental building block of economic independence, your own housing, becomes unattainable for people in their 20s and 30s, you have a structural economic failure. But because it happens gradually, one delayed milestone at a time, it doesn't trigger the alarm that a stock market crash would. What comes next is the core analysis of why this is happening and why it's being systematically underreported. Let's talk about debt. France's debt to GDP ratio is 117%. That's higher than it was during the Eurozone debt crisis. France is currently under the EU's excessive deficit procedure, which is the formal process for member states that violate fiscal rules. To address this, France implemented a temporary corporate tax increase to 36.1% for 2025. Temporary, officially. But here's what the data from the European Parliament shows. When governments implement temporary revenue measures during fiscal stress, those measures tend to become permanent, because the underlying fiscal problem doesn't resolve itself. Italy's debt to GDP ratio is 140%. 140%. Italy's interest costs now consume a significant portion of the national budget. And here's the trap. When your debt is that high, you're vulnerable to spread widening. If bond yields increase even half a percentage point, Italy's interest costs surge. That forces either spending cuts or more borrowing. Both options are contractionary. Spending cuts reduce economic activity directly. More borrowing increases the debt burden, which makes the problem worse next year. This is the refinancing trap. And it's not unique to Italy. Spain, Portugal, and Greece all have debt levels that leave them exposed to interest rate volatility. The ECB has been easing, yes, but global bond markets are still repricing risk. If yields rise, heavily indebted member states face immediate fiscal pressure. Now, let's examine the private sector. According to the Bank for International Settlements, corporate debt service ratios in Europe are stable but rising. That sounds contradictory, but here's what it means. Companies are servicing their debt. They're not defaulting en masse, but the percentage of revenue going to debt service is increasing. That's revenue that doesn't go to investment, doesn't go to hiring, doesn't go to wage increases. It goes to creditors. Private investment across the Eurozone is stalling, not collapsing, stalling. Businesses aren't expanding, they're consolidating, preserving capital, waiting for clarity. That might be rational at the firm level, but at the aggregate level, it produces stagnation. Because if no one invests, there's no productivity growth, no innovation, no competitive advantage. The economy treads water. And here's the part that should worry you. Shadow banking, the non-bank financial intermediation sector, has grown unchecked. Private debt in Europe is up tenfold since 2007. Tenfold. That's leverage building outside the regulated banking system. The Basel III regulations that were supposed to prevent excessive risk-taking in banks. Delayed, watered down, partially implemented. Meanwhile, the actual risk has migrated to less transparent parts of the financial system. If there's a shock, a geopolitical event, a sudden repricing of risk, the exposures are there. We just can't see them clearly. Let's talk about trade, because this is where the global and European pictures intersect. Allianz Trade, one of the most credible sources for trade finance analysis, forecasts global trade growth falling from 2% in 2025 to just 0.6% in 2026. 0.6%. That's functionally flat. For an export-dependent region like Europe, flat trade growth is a major problem. Germany's economy is built on exports, automotive, machinery, chemicals. When global trade stalls, German industrial output stalls, and when Germany stalls, the Eurozone stalls. The European economic model for the past 2 decades has been export-led growth. Produce high-value goods, sell them globally, reinvest the surplus. That model is breaking down. Chinese competition in manufacturing, American protectionism, slowing global demand. Europe's export markets are shrinking. And the internal European market isn't large enough or dynamic enough to compensate. Consumption growth is weak because real wages are flat. Investment growth is weak because businesses are cautious. Government spending is constrained by debt levels. Exports are the only growth engine left, and exports are sputtering. Here's where it gets interesting. Why isn't this being reported as the crisis it actually is? Because it doesn't fit the media narrative of what a crisis looks like. A crisis needs a catalyst, a Lehman Brothers, a Greek default, a bank run, something visual, something that happens on a specific day that you can point to and say, that's when it started. This isn't that. This is a slow-motion unraveling. GDP growth at 0.9% isn't a headline, it's a footnote. Inflation at 3.4% is annoying, but it's not hyperinflation. Debt at 117% of GDP is concerning, but France isn't defaulting. Each individual data point taken in isolation is manageable. But when you combine them, you get a picture of an economic system under chronic stress. And chronic stress doesn't make headlines. It just grinds people down year after year until one day they look around and realize they're worse off than their parents were at the same age. That realization is happening now, across Europe. But because it's gradual and diffuse, it doesn't trigger the political or media response that a sudden crisis would. Now let's examine the psychology behind this, because understanding why this is happening is just as important as understanding what is happening. The European economic model is built on certain assumptions: fiscal discipline, export competitiveness, social cohesion, regulated markets. For 30 years, those assumptions held. The euro provided monetary stability, the single market provided scale, Germany provided industrial strength, Southern Europe provided labor cost flexibility. It worked, until it didn't. The 2008 financial crisis exposed the first cracks. The eurozone debt crisis exposed more. The pandemic exposed the rest. And what we're seeing now is an economic model that's exhausted. The fiscal space is gone. Debt levels are too high to allow counter-cyclical spending. The monetary space is constrained. Inflation is too high to allow aggressive easing, but growth is too weak to justify tightening. The structural reforms that economists have been recommending for 15 years, labor market flexibility, pension reform, tax simplification, are politically impossible. Because they require short-term pain for long-term gain, and voters punish short-term pain, so governments do nothing, or they do the minimum. Temporary tax increases, incremental spending cuts, symbolic reforms, none of it addresses the underlying problem. Here's the behavioral economics angle. Humans are loss-averse. We feel losses more acutely than equivalent gains. A sudden 50% stock market crash triggers immediate action. Panic selling, policy intervention, media coverage. But a 3% annual decline in real purchasing power? That's gradual enough that people adapt. They cut back on small luxuries. They delay purchases. They adjust expectations. It doesn't feel like a crisis because it doesn't happen all at once. It's the boiling frog analogy. And I know that analogy is overused, but it's overused because it's accurate. If you drop a frog in boiling water, it jumps out. If you put it in cool water and slowly raise the temperature, it stays until it's too late. That's Europe right now. The water is heating. People feel uncomfortable. But the change is slow enough that it doesn't trigger the fight or flight response that a sudden crisis would. So they stay, they adapt, they cope, until the cumulative effect becomes undeniable. And here's the institutional angle. The European Union is a complex governance structure, 27 member states, different fiscal policies, different political systems, a shared currency for 20 of them but not all. Decision-making requires consensus, and consensus requires compromise, and compromise produces incremental, diluted policy. The kind of bold intervention that might actually address these problems, centralized fiscal policy, Eurobonds, coordinated industrial strategy, requires political will that doesn't exist, because it would require Northern European countries to accept risk-sharing with Southern Europe. And voters in Germany and the Netherlands don't want that. They see it as subsidizing fiscal irresponsibility. Meanwhile, Southern Europe sees austerity as imposed suffering that benefits Northern creditors. Both perspectives have some validity, and that's the trap. The political economy of the Eurozone makes bold action nearly impossible. So what you get is muddling through. Extend and pretend. Kick the can. Hope something changes. But nothing changes. And the slow decline continues. Let me show you how this connects to your personal financial reality. Savings rates are declining across Europe, not because people are spending more on luxuries, because consumption is increasingly funded by drawing down savings or increasing consumer debt. According to data from the OECD, Household savings rates in the Eurozone have fallen from an average of 14% during the pandemic, when people couldn't spend, to around 8% now. That's a significant drop. And it's not because incomes are rising, it's because people are maintaining consumption by saving less. That works until the savings are gone, then consumption falls. And when consumption falls, the economy contracts. We're not there yet, but the direction is clear, the buffer is shrinking, and there's no policy response that addresses this, because the policy tools are exhausted. Fiscal policy is constrained by debt. Monetary policy is constrained by inflation. Structural reform is constrained by politics. So, the trajectory continues. Now let me connect these insights into a coherent framework, because this isn't just about understanding the problem, it's about understanding what it means for your financial decisions. The hidden recession thesis is this: Europe is experiencing economic decline that official statistics understate because those statistics measure flow, not stock. GDP measures annual output, but it doesn't measure wealth destruction, debt accumulation, deferred maintenance, declining real wages, housing unaffordability. These are stock problems. They accumulate over time, and they produce economic fragility that doesn't show up in quarterly GDP reports until it's too late. When you combine near-zero growth, above-target inflation, record debt levels, stalling investment, collapsing trade growth, and a financial system with hidden leverage, you don't have a healthy economy experiencing temporary headwinds. You have a structurally impaired economy that's vulnerable to shocks. And the next shock, whether it's a geopolitical crisis, a financial market repricing, or a political fracture, won't hit a resilient system. It will hit a system that's already under stress, and the policy tools to respond are largely depleted. So what does this mean for you? Defensive positioning. That's the framework. If you're holding cash, understand that inflation is eroding it at 3 to 3.6% annually. That's guaranteed loss of purchasing power. If you're in leveraged growth investments, understand that the growth assumptions underlying those valuations may not materialize in a 0.9% GDP growth environment. If you're considering major purchases financed by debt, understand that interest rates may stay elevated longer than current pricing suggests, and refinancing risk is real. The investment strategies that worked in the 2 to 3% growth environment with low inflation don't work in a 1% growth environment with 3% inflation. You need to reprice risk, reduce leverage, increase liquidity, consider hard assets. And I'm not saying this to be alarmist, I'm saying this because the data supports it. The European Central Bank's own financial stability reports flag rising corporate debt service costs and housing market vulnerabilities. The European Commission's forecasts show stagnant growth and persistent inflation. Alliance Trade shows collapsing trade growth. These aren't fringe sources. These are official institutions. And they're telling you, in careful, diplomatic language, that the risks are elevated. Here's the part that might challenge your assumptions. Precious metals. Gold and silver have historically been inflation hedges and crisis assets. In a stagflation-like environment, where growth is weak and inflation is sticky, hard assets tend to outperform financial assets. I'm not suggesting you put your entire portfolio into gold, but a 5 to 10% allocation as insurance? That's not irrational given the current environment, because the scenarios where you lose money on that allocation, strong growth with low inflation, are the same scenarios where your other assets perform well. It's asymmetric. Limited downside if things go well, significant upside if things go poorly. That's the kind of positioning that makes sense when the base case is stagnation and the tail risk is crisis. Let me bring this back to the opening image. You check the news. European markets are stable. No crash warnings. Official forecasts say modest growth. Everything looks fine. Except it's not fine. Your paycheck buys less. Your rent went up. You're saving less. The disconnect between official reassurance and lived experience is the hidden recession. It's real. It's measurable. And it's not being reported because it doesn't fit the narrative template of what a recession is supposed to look like. But now you understand why it's happening. The exhausted economic model. The depleted policy tools, the political constraints, the slow accumulation of structural problems that don't make headlines. This isn't about predicting a crash. Crashes are unpredictable. This is about recognizing the environment you're operating in and adjusting your strategy accordingly. Because the official guidance, keep calm, modest growth ahead, is based on models that don't capture the reality of 3% inflation eroding wages, while debt consumes 40% of government budgets, and trade growth collapses to 0.6%. What economic topic would you like me to analyze next? European labour market fragility. The real state of the banking system? The coming fiscal reckoning for highly indebted member states? Let me know in the comments. The data is clear. Europe's hidden recession is already here. The question is whether you're positioned for the reality or still operating on the assumptions of an economic environment that no longer exists. Understanding the difference is what separates those who preserve wealth through this period from those who watch it erode 3% at a time, year after year, wondering why the official forecasts never match their bank account. You now have the framework, the analysis, and the uncomfortable truth. The action, as always, is up to you.